Meet Robert, 66 years old, retired 2 years ago after 31 years at the same company. He did everything they told him to do, paid off the house, built a modest portfolio, took his required distribution right on schedule, bought some municipal bonds because his advisor told him they were the safe tax-free choice. In 2024, Robert's income, his real modified adjusted gross income, was $108,999. $1 under the line. If he'd stopped there, his Medicare bill this year would be the standard premium. Nothing extra. Not 1 cent of penalty. But he didn't stop there, and 2 years later in the mail, Robert opens a letter from Medicare. His premium just went up. Not by $10, not by $50. His new bill is $1,148 higher for the year. Automatically, permanently for that year. Deducted straight out of his Social Security check. Robert didn't miss a payment. He didn't break a rule. He crossed a single dollar, $1, over a line he didn't even know existed. And by the time he saw the bill, the year that caused it was already closed. There was nothing left to undo. This is not a graduated tax that eases you in. This is a cliff. And in a minute, I'm going to show you exactly where that cliff sits, the exact number, the exact dollar, so you can find out right now which side of it you're standing on. Now, before I go further, the lawyers want me to remind you, this isn't financial advice. It's a warning. So treat it like one. This is education. And the specific numbers for your situation go to a professional who actually works for you, not to Medicare, not to the IRS. Stick around, because what I'm about to show you is the exact math Medicare doesn't put in plain English anywhere. And if you've got a retirement account, a pension, or you're even thinking about a Roth conversion this year, you need to see where this line sits before you cross it by accident. Drop your state in the comments right now, because this line hits every single one of you the same way, no matter where you live. Here's what nobody tells you about this trap. It doesn't only hit millionaires. It doesn't only hit people with a private island and a yacht. Right now, roughly 1 in every 13 people on Medicare is paying this penalty. And if you've got a pension, a required distribution, some investment income, CIPRO, you are exactly the profile this hits hardest, because $109,000 a year is not rich. That's an ordinary retirement. That's Robert. So if you're sitting there thinking, that's not me, I don't have that kind of money, I want you to hold off on that thought until the end of this video, because most people who get hit by this never see it coming. They don't feel wealthy. They just did the normal things retirees do. Took their required withdrawal, maybe sold a property, maybe moved some money into a Roth account to save on taxes down the road. And each one of those ordinary moves can push you over that line without you ever realizing it happened. And here's the part that makes this worse than almost any other tax trap out there. This isn't a bill that shows up right away when you'd still remember what caused it. This penalty can hit you 2 full years after the decision that triggered it, which means by the time you see the damage, you've already forgotten what you did to deserve it. I'll show you exactly how that works in a minute, and it's going to change how you think about every financial decision you make from this point forward. So let's name it. This penalty has a name, and Medicare barely explains it anywhere you'd actually see it. It's called IRMAA, the Income-Related Monthly Adjustment Amount. It's not your Medicare premium. It's stacked on top of your Medicare premium. Right now, the standard Part B premium for 2026 is $202.90 a month. IRMAA is what gets added on top of that number once you cross the line. And here's the first thing that's going to make some of you angry. IRMAA doesn't look at your taxable income. It looks at something called your modified adjusted gross income, your MAGI. That's your adjusted gross income plus something a lot of you have specifically avoided for tax reasons, tax-exempt interest. That's right, municipal bond interest, the income you bought specifically because you were told it was tax-free still counts against you here. You did the responsible thing, and Medicare counts it anyway. Now here's the line itself. For a single filer, based on your 2024 income, the moment your MAGI crosses $109,000, you owe an extra $81.20 a month on Part B, plus $14.50 a month on Part D. Add it up, and that's $298.60 a month in surcharges, about $1,148 a year. Not because you earned $20,000 more, because you earned $1 more. And it does not stop there. Cross $137,000 and your penalty jumps to roughly $2,886 a year. Cross $171,000, you're at $46,119. Cross $205,000, you're paying over $6,000 a year in penalties. Every single year you stay above that line. And at the very top, over $500,000, the number tops $6,900 a year. Every tier works exactly the same brutal way. There's no ramp. There's no phase in. You are either under the line or you owe the entire tier. Now, if you're married and you're both on Medicare, and I need you to hear this clearly, this penalty is not charged per household. It's charged per person. So if you and your spouse are both drawing Medicare and your joint income crosses $218,000, you're not paying $1,148 once. You're paying it twice. $2,397 a year for the both of you, from the exact same single dollar that pushed you over. And if you're divorced or you've recently lost a spouse and you're filing separately, hang on to that thought, because your version of this trap is even worse. I'll come back to that later in this video because you need to hear it before you file your next return. Now here's the part that turns this from a bad surprise into something genuinely dangerous. Remember Robert's letter? The one that showed up 2 years after the fact? That's not a coincidence. That's how the system is built. Your 2026 Medicare bill, the one you're paying right now, is not based on this year's income. It's based on your 2024 tax return, the one you filed last year, and the decisions you make this year in 2026, a Roth conversion, selling a property, taking a bigger distribution. Those decisions won't show up on your Medicare bill until 2028. By the time you see the number, the tax year that caused it is closed. There's no going back. There's no do-over. You find out you crossed the line a full 2 years after you already crossed it. So let's talk about exactly what pushes people over that line, because it's almost never a windfall. It's the normal stuff. Required minimum distributions. Starting at age 73, the government forces you to pull money out of your retirement accounts, whether you need it or not. And every dollar of that counts as ordinary income, straight into your MAGI. Roth conversions, this one's going to sting, because so many of you have been told converting to a Roth is the smart move. Pay the tax now, enjoy tax-free withdrawals later. And that's true, long term. But in the year you convert, that entire converted amount lands in your MAGI. People do the smart, disciplined thing and get hit with a Medicare surcharge 2 years later for doing it. Selling a second home or a rental property, one good year, one closing, one capital gain, and your MAGI spikes for that single year, even though your income goes right back to normal the next year. Doesn't matter. IRMAA doesn't care that it was a one-time event. It charges you as if that income is permanent. And if you inherit a traditional IRA, those required distributions flow straight into your MAGI too, often catching heirs completely off guard in a year that's already emotionally difficult enough. There's one more trap almost nobody mentions. If you're on a Part D drug plan, and even if a former employer is covering your Part D premium for you, the IRMAA surcharge on Part D still gets billed to you directly by Medicare, separately. It doesn't matter who's paying your premium. This one specifically catches federal retirees and union retirees off guard because they assume employer coverage means they're protected. It doesn't. And if you're sitting there thinking, I've got Medicare Advantage, this doesn't apply to me, slut urine. It does. IRMAA applies to Medicare Advantage plans with drug coverage exactly the same way it applies to original Medicare. There is no version of Medicare that lets you dodge this. So if the damage from a decision you make today doesn't even show up for 2 years, is there any way to undo it once you see the bill? There's one form that can do it. And I need to tell you honestly, about half the people who try to use it get it wrong. The form is called SSA 44. It's officially titled Medicare Income Related Monthly Adjustment Amount, Life-Changing Event. And what it does is simple. It lets you tell Social Security that your income situation has genuinely changed. So they recalculate your IRMAA off more recent numbers instead of that closed 2-year-old tax return. But here's where I need to be completely straight with you, because this is where half the appeals fail. SSA 44 only works for specific defined life events, not for any income change. For 8 qualifying events, and only these 8: retirement or reduction in work hours, marriage, divorce, the death of a spouse, the loss of a pension, the loss of income-producing property, or an employer settlement payment. Notice what's not on that list. A Roth conversion does not qualify. Selling a rental property for a gain does not qualify. Those are voluntary financial decisions, not life-changing events. And if you try to appeal using either one of those, Social Security will deny it. That's not me being negative. That's the actual rule. And I'd rather you hear it now than get your hopes up filing paperwork that was never going to work. Advocacy groups that track these appeals report that roughly half of them get delayed or denied, and it's usually not because the person didn't qualify. It's paperwork errors, missing documentation, wrong forms missed the window. So if you do have a genuine qualifying event, you've got 60 days from the date on your IRMAA determination letter to file. 60 days. Don't sit on it. Now, if none of those 8 events apply to you, and for a lot of you watching, they won't, your real defense isn't an appeal. It's timing, decided before December 31st, not after. Know your MAGI now, not your taxable income, your actual modified adjusted gross income, including any tax-exempt interest. Most people don't calculate this until their accountant hands them a number in April, and by then, the year's already locked. If you're planning a Roth conversion, consider spreading it across multiple years instead of one lump sum, specifically to avoid pushing a single year's MAGI over one of these lines. That's a conversation for your tax professional, not a decision to make from a video. But now you know the exact reason to bring it up with them. If you're planning to sell a rental property or a second home, think about which tax year that gain lands in. And remember, it echoes 2 years later on your Medicare bill, not right away. And if you're recently divorced or widowed, remember what I told you earlier. Married filing separately collapses these income brackets down to 3. And I want to actually walk you through this one because the number is going to shock you. If you file married filing separately, the very first threshold is still $109,000. Same as a single filer. But here's where it stops looking anything like the single filer table. Cross that line by even $1. $109,001. And you don't land in a gentle first tier. You jump almost straight to the 4th tier on the regular table. That's not an extra $81 a month. That's roughly $446 a month in Part B surcharges alone, plus another $83 a month on Part D. Over $6,200 a year, triggered by $1 the very first time you cross the line at all. There is no Tier 1, no Tier 2, no Tier 3 easing you in. For a married filing separately return, it's $109,000 or $6,000 a year, nothing in between. So if your filing status just changed, you got divorced, you lost a spouse, you're filing separately for any reason, this is exactly the year to sit down with a professional before you file, not after. Here's what I need you to sit with. Right now, today, in 2026, some decision is being made. Maybe it's yours, a conversion you're thinking about, a property you're about to list, a distribution you haven't calculated yet. And whatever that decision is, it is quietly setting a Medicare bill that won't arrive until 2028, not next month, not next year, 2 years from now, when you've long since moved on and forgotten the choice that caused it. So do this now before you close this video. Pull your most recent tax return and find your actual MAGI, adjusted gross income plus any tax-exempt interest. Compare it to $109,000 if you're single, $218,000 if you're married filing jointly. Know exactly which side of that line you're standing on. And if a life event, you see a retirement, a divorce, a loss of a spouse, has happened to you in the last 60 days, that SSA 44 clock is already running whether you've filed the paperwork or not. Robert didn't lose everything. He's not ruined. But he spent a year paying $1,148 extra because nobody ever showed him where that line was. And by the time he found out, the year that caused it was already gone. You don't have to be Robert. Now you know exactly where the dollar is hiding. You know the number, you know the look back, and you know the one form that can undo it if you genuinely qualify. That's the difference between finding out from a bill 2 years from now and finding out from this video today. If this helped you see something you didn't know about your own retirement, tell me in the comments which one of these triggers worries you most, the RMD, the Roth conversion, or selling a property. I read every one of them. And if you know someone who's sitting right on that line and doesn't know it yet, send them this video before they cross it.